In light of Australia's very poor GDP result this week, we thought we'd investigate previous recessions and look for any evidence or data that might support the case for Australia moving into a recession. So initially, just looking at the chart of Australia's GDP going back to 1958, we have identified 5 recessionary periods, 4 that are fairly well agreed upon, perhaps a fifth that is a little bit more difficult to reconcile, but essentially the early 1960s, 74, 75, certainly 81 through to 83 and 89, 92, and there's another one in at the tail end or very close to the 74, 5, 76, 77, according to the Melbourne Institute. So they're the recessions. We saw the number come out this week, minus 0.5%, and that has a number of people talking about whether Australia is on the verge of recession. The annual number growth rate has come down to 1.8. That's the lowest we've seen in at least or since the global financial crisis. So in this session, we're just going to investigate the likelihood or otherwise of a recession in Australia. So what we're going to do first is identify these recessionary periods as regimes. So we've set up a series called Regime Australian Recession. You can see those identified by the shaded areas. What I was interested in is, and a number of people have talked about this, we've had 4 negative quarters since the last recession, which was 25 years ago, and you can see these here. There's 0. These are negative quarterly outcomes. So this is the 4th that we've had in that period. But as you can probably see, we've had quite a number of negative outcomes that haven't been identified with recession. So in fact, if we look back historically, we can see that Australia has spent, since 1958, 17% of its time identified as being in recessionary periods, according to the Melbourne Institute definitions. And so 83% of the time not in recession. Now, in the recessionary periods, we've had 19 quarters of negative growth during periods identified as recession, but we've also had 18 negative quarters where we actually haven't been in recession. So roughly 50% of the time we've had negative quarters, but not been in recession. So what we'll do now is have a look at some of the recent indicators and discuss whether they are pointing to a more dour assessment or perhaps a recession in Australia. As I said, statistically, it looks like when you've had a negative quarter or one quarter, there's a 50% chance of recession. So is that the probability? We would suspect it's quite a bit lower than that. The probability over all periods is something like 17%. Over the period from 1958 to 1993, Australia spent 30% of its time in recessionary period. So it is very much dependent on the period. We can see that post the float of the currency and post the independence of the RBA, recessions have occurred very rarely in Australia. So turning first to the employment data, this is total employment. We can see and here, in this case, we only have data going back to the late 1970s, so we're not capturing many recessions at all, but certainly the 81, 89 beginning of recessions. So the employment data, with employment growth basically flat over the past quarter, you can see that there compared to the recessions of 81 and 89. So we're on track there, and in fact, we're on a worse starting point than we were on those 2 occasions. You might think that US GDP is one of those areas that we should look at, given a lot of these recessions are global phenomena. So if we just look at this here, we can see that this is looking at US real GDP on a quarterly basis. So US real GDP increasing 0.8% in the most recent quarter. But looking at it this way, we can see the shaded areas there, the Australian recessions. US was also in recession there. US was in recession here, but Australia wasn't. And certainly in the mid-70s, the US was in recession, as it was in the early 80s and the early 90s. US was in recession in early 01 and also 07, 08, but Australia managed to escape. So it's the US economy, and indeed the global economy, is certainly not suggestive of recession at the present time. So now just turning to some of the components of GDP and to see where they are currently situated. So household consumption, obviously that's the biggest component. Private sector, that's almost 60% of GDP in the most recent quarter. And although the last number at around about 0.4%, the last two numbers have been quite subdued, they are nevertheless a long way from being associated with recessions in the past. But it is unusual to have consumption going into negative territory, but it is some way off. But what about more recent, say, retail sales data? We do have some, and this, obviously the GDP only goes to the September quarter. We do have some more recent information on the retail sales data, although it is nominal in this instance, and we have some October data, but the last 3 months have averaged about 0.5% monthly gains. So it's suggesting, at least in nominal terms, that retail sales have picked up after sliding during the middle part of the year, and consumer sentiment is probably near as high as it's been for the past couple of years. So there's the most recent partial data, and we only have 1 month to go by, and it is nominal. It does suggest that consumer spending may have actually lifted in the early part of the December quarter. Perhaps one area that does present a risk, and is a bit of an unknown at this stage, is the state of the housing construction market. Now, dwelling investment is roughly 6% of GDP in the most recent set of numbers, so it's a fairly significant component of the overall economy. And we saw in the October data, and indeed in the last 3 to 4 months, high-rise dwelling approvals have fallen by about 40%. So that's the red line, and have been so strong for quite some time. And so the overall dwelling approvals have fallen back to levels where they were a couple of years ago. They're still quite high, but nevertheless, this is a bit of a worrying sign. What does that mean for overall GDP growth? So we actually, if we do a regression and look at the dwelling approvals, and it tends to have about a 6 to 9 month lead on dwelling investment, and we model that. So private dwelling investment, I'm looking at 12-month change, and the model that we're using dwelling approvals with a lag of 6 months, 12-month change. So that's suggesting, as I said, we've seen about a 25% decline in dwelling approvals over the past 12 years. That's suggesting with this model that could amount to about a 10% fall in private dwelling investment over the next 12 months. This is, of course, if it's sustained. And at 6% of GDP, that would detract about 0.6% from GDP growth over the next 12 months. So the recent data is a bit of a concern. It does suggest that the momentum is declining in the housing sector, particularly in the high-rise components, and could present some downside risks to the economy. Not so much in the next quarter, but certainly over the next 12 months. As I said, the dwelling approvals data tends to operate with a fair bit of a lead, anywhere from 6 months up to possibly even 12 months. Next, we turn to non-residential construction. Now, this is the area that's been hit particularly hard by the downturn in the mining sector over the last few years. And indeed, non-residential construction investment has declined by about 25% over the past 12 months. That's the only other period where it's had a larger decline is in 1999-2000. So it's a significant decline, and at approximately 5.5% of GDP, it's detracted a very significant amount of, over 1% from GDP over the past 12 months. So the non-residential construction sector has been a key drag on the economy, as it was. If we look at just the quarterly numbers, you can see there it wasn't as bad as the previous quarter, but nevertheless another negative result overall. So what's the outlook? Well, I guess in some sense there are at least some glimmer of hope, particularly if we use, say, commodity prices and the turn in the terms of trade. So here I'm looking at, actually we'll do 2-quarter change in non-residential investment. That's the blue line. The pink line over the top of that is the terms of trade. So with commodity prices jumping quite sharply over the course of this year, and in particular the last 6 months, we can see the terms of trade is up 7% in the last 2 quarters. So it perhaps suggests that not so much of a rebound, but certainly a stabilisation in the downturn of non-residential construction. It is a slow-moving area of spending, but at least, as I said, commodity prices stabilising and picking up should see some stabilisation in this actual component over the next 12 months. Unlikely that we'll see any improvement in the very short term, however. So to sum up, there's certainly a less than a 50% chance, as suggested statistically, of Australia entering recession. I guess the best and the brightest news in recent times, and sort of leading out of the September quarter into the current December quarter, has been the pickup in retail sales. As I mentioned, part of that has been in price increases, perhaps. We've also seen commodity prices pick up, so that should also help nominal levels of growth. So there's a few indicators there that give room for optimism. The risk, of course, seems to be around the developments within the housing sector and seeing a very sharp decline, but that seems to be more of a risk over the next 12 months than a very immediate risk. Just want to finish up with a chart that just looks at trends in GDP, both in nominal and real. And what we're doing here is we're taking a trend growth rate in real GDP. That's the red line. The gold line is the actual GDP. So you can see there that the trend has slowed from something like 3.25 down to about 2.75, and that might give you some sort of indication as to what Australia's potential growth rate is in real terms, around about 2.75. But the interesting one is nominal GDP, which, as you might expect, is typically well above real GDP, but in the past couple of years, that's actually gone below real GDP in trend terms. Now, and that obviously reflects the decline in the terms of trade and prices more generally. But what we've seen in the most recent couple of quarters is a bit of a pickup, not only in commodity prices, but also national incomes. And so nominal GDP growth looks like it's started to pick up. And in fact, over the past 12 months is now back ahead of real GDP growth. Thank you.